This is Al Brooks, and this is my price action trading course. The current module is on extreme scalping. Almost every bar is a setup for a scalp, and extreme scalpers take 20 to 40 scalps a day on the 5-minute chart. Some of them trade off 1, 2, or 3-minute charts, or tick charts, or volume charts with small numbers of ticks or shares per bar, so that they have 100 or 200 bars per day. Extreme scalping is a manual form of high-frequency trading. So you're doing pretty much what the high-frequency trading firms are doing using computers, and you're doing it by hand. It's extremely difficult to do profitably. The computers have the advantage of having everything automated, so they're entirely objective on every trade, and they manage their trades properly every time. And it's very difficult to do manually, but it's possible. Scalping always looks easy. You look at it and say, well, the risk per trade is not very big, so I'm not risking very much, and therefore it's worth giving it a try. But you have to remember the profit is also small. My first recommendation is not to do it. You will lose money. It looks so easy at the end of the day when you look back at the price chart. It's actually very difficult to do real time. You have to make constant decisions, lots of decisions, hundreds of decisions, and you have to make a lot of them right. And very few great traders can make money using extreme scalping, and very few actually make money doing any kind of a scalping. For the most part, traders who are making money are going for swings, and by swings I mean a reward 2 times greater than the risk or more. What's the problem with extreme scalping? It's the trader's equation. The risk usually is greater than the reward. And when that's the case, the probability has to be 70% or more. And most traders simply cannot be 70% correct 40 times a day. Remember, 70% correct is just a break even. If your risk is 6 or 7 ticks and you're making 4 ticks, you have to be right 70% of the time, all day long, every day, every month, every year, to make money. And that's impossible for even most really good traders. The biggest problem, I think, is not enough time to assess the probabilities. And the probability is often much lower than it appears. And avoiding bad setups is extremely difficult. Very often you'll find yourself entering a trade, and then once it's 2 or 3 ticks against you, you look back and say, gosh, I shouldn't have taken this one. And these infrequent mistakes are all that are necessary to make you lose at the end of the day. So this is my recommendation. Don't do it. However, some people can do it. I did it for years. Paul Rotter is an example of an extremely successful extreme scalper, and you can look him up on the internet. You can do a Google search of Paul Rotter. Supposedly he made $60 million a year for many years, and he said that sometimes he places hundreds of trades an hour for just a few ticks each in the Forex market. So he's doing high-frequency trading by hand. So why am I discussing it if I'm saying don't do it? Because it reminds traders that the market is saying something with every tick. And it's also fun to think about what the very best traders in the world are capable of doing. There's nothing special about the techniques. It's the same techniques that you use to trade any chart on any time frame. For example, here's a 5-minute E-mini chart, and here is about an hour's worth of trading. And what I'm going to do is I'm going to discuss extreme scalping during this 1 hour period. I could have picked any similar period on the chart and come up with the same approach, and what I'm choosing is these 14 bars, and I'll discuss what I see on those bars, 1 bar at a time. Okay, so here is a close-up of those bars, and I'm going to talk about extreme scalping during these 14 bars. Okay, bar 1. Okay, you have 4 consecutive bull bars, all with good bodies, and a close near the high, and a close above the moving average, and the entire day is above the moving average. So this looks like an opening reversal with a strong signal bar, and it looks like it might be a bull trend day. So if you just turn on your computer at this instant, you buy the close of that bar. Your initial stop might be below the low of the bar, and you can adjust your reward based upon your actual risk. But right now your initial risk is down here. And throughout these 14 bars, I'm talking about going for 1 point profit. Okay, it's still a buy. Fifth consecutive bull bar above the moving average. The tail is a little bit bigger than it was over here. This is the E-mini chart, by the way. It's still a buy the close market, but it's obviously better to buy a 1 or a 2 point pullback because this might be getting extreme. And if you look at the slopes here, okay, this across the tops here, it's more vertical here, and it's getting a little bit flatter here. So we're starting to get an S-shaped curve. It's subtle from here to here, and then more vertical, and then less vertical. So the market is losing a little momentum. Here's the third bar. It's an inside bar, and it's a doji bar, and it's a pause, the first pause after 5 strong bull bars in a gap up day with a trend from the open bull at the present time, an opening reversal with a strong signal bar. So there probably are buyers below. It's still a buy the closes market. You can still buy this close, but at this point I think it's better to buy a 1 or a 2 point pullback if we get one. So you could buy this close, you could buy that close, you can buy this close. Here, if you bought the close, you could have made a point. If you bought this close, you did not yet make a point. If you bought this close, you have not yet made a point. Now we have an II pattern, possible low 2 short on the day. We had a low 1 here, we have a low 2 here, and a bear inside bar. So it's possible that we'll get a pullback. In fact, it's likely that we'll get a pullback. And it's a close below the close of the prior bar. However, with 5 consecutive bull bars closing near their highs, the odds are very high that there are buyers below. So you can either wait or buy at the low of the bar and again add on 1 point lower. There are almost certainly buyers below because the swing bulls will keep buying all the way down with a stop below here. So I think everyone's going to be buying. So you can buy this close, you can buy this close, you can buy this close. You can place a limit order to go long at the low of that bar. And your stop, initial stop, is probably down here. I would use the swing stop. You could use a smaller stop, 2 or 3 points, but I think I would use the swing stop and look to add on as the market goes down. A third inside bar. This time it's a bull bar. So the market's in breakout mode, and there's too much buying pressure, I think, to short. Okay, 4 sideways bars, 3 have tails on top right here, and 1 is a doji, and 1 is a bear bar. It's a tight trading range, so a failed breakout up or down is likely. When the market starts to enter a tight trading range and you start to get bars with tails and the bars get small and you get doji bars, chances are whatever breakout there is will not get very far, and it will get pulled back into the tight trading range. A tight trading range, like any other trading range, is a magnet, and breakouts usually don't get far and they get pulled back in. At this point, should you buy above 5? I would be hesitant to buy above 5 because there might be sellers there. We sold here, this tail, a tail above here, a tail above here. So I would not be buying above bars. I would consider buying below bars. What about shorting below bars, betting that it's the high of the day? I don't think so. I think the strength of this spike is so good that there'll be buyers below and they'll be scaling in below. So how would I handle this? You could put a limit order to sell above 5. I would not do that, right? The market is too strong. Instead, I would put a limit order to buy below 5. Or you could wait to see if you can buy lower. All right, bar 6. We now have more of a tight trading range, and we possibly have a trapped bull situation. The bulls who bought above 5 are probably trapped, and they will look to stop themselves out below 5, right? We went down, they triggered their long above here. A lot of the bull scalpers certainly will get out below 5 or 6, and it's a micro double top. There's plenty of room to the moving average. We're about 3 points above the moving average and at least 2 points above the breakout point. So there's room below for a scalp. One thing that traders might consider doing is looking at this as a failed III triangle or bull flag. We have the two bear bars. Try to short below on a stop. Place a sell stop below 6 on a stop to capture the trap bulls exiting their longs. If you did take that short, you would be short on bar 7. Now, if you're a bear and you're short on bar 7, at this point you have a high 2 buy above 7. So I think you should exit your short above 7 and maybe even go long above 7. What about shorting below 7? If you're already short at the 6th low, I would not add to my shorts, but I would definitely get out of shorts above 7 because it's a high 2 and a reasonably strong bull trend. So right now I would be short right here at the low of bar 6, entering on 7, looking for a 1-point scalp down, but I would get out above 7 and take the loss. That's a good bar for the bears, and it fell 6 ticks below 6, and that would allow bears to get out with a 1-point profit. So the scalpers get out with a 1-point profit. There's a big tail on the bottom of 8, so that shows that there's some buying. And look, we have 3 bear bars, 1 and then a bull bar, 2 and then a bull bar, and then 3. So this is 3 pushes down, and it's a bull flag, so it's essentially a wedge bull flag. I would definitely get out of shorts. Buying above 8 probably makes sense, but I'd rather buy low. What about simply reversing to long and then scaling in lower? I think that's okay. The thing I would be most interested in doing at this moment is taking profits on my short below 6. Okay, 3 pushes down, 4, 6, and 8. You have a doji inside bar for the signal bar for the wedge bull flag. It's a weak signal bar, but it's a pretty strong bull trend. There probably are buyers around the moving average, so it's probably safe to buy. For the bears, they view 9 as a pullback from the 8 breakout. I think there'll be buyers not far below, so I think it's okay to buy the 9 low. I also think it's okay to buy above 9 because it's the signal bar for a wedge bull flag and a pretty strong bull trend. I think the buy signal is still intact. We now have 4 pushes down, 1, 2, 3, 4. So it's a channel with 4 pushes down, so it's a high 4 buy setup, and I think it's an okay buy scalp above 10. And it probably was okay to buy the 9 low. I say okay to buy the 9 low because I think it's a bad sell signal, so there probably are buyers below. Outside bar after outside bar after a smaller outside bar, so tight trading range. We have a bar, outside bar, bigger outside bar, tight trading range. In general, bad for stop orders, good for limit order entries. It's just above the moving average, so I would not be looking to short. I would be holding long, either from my long at the 9 low, filled on bar 10, or I would be buying as 11 went above 10, and at this point probably put the stop below 11. Still continuing as a tight trading range. Most tight trading range breakouts fail, and we're trying to break out. You can argue this is a low 2 short. The first short is below 9, second short below 12. I would not take the short. We're still too close to the moving average. I would continue to hold long, either from buying the 9 low or from buying the 10 high, and I would be trying to scalp out for 1 point if we go a little bit higher. My stop at this point would be below 11. 13, a bad bar for the bull case. If you bought the 9 low, you've already scalped out for a 1 point profit. If you bought the 10 high, this is basically a low 2 short. We went down on 8 and then up on 9, and then down on 10, 11, and then up on 12. So to me, had I bought above 10, I would exit below 13 and take a loss. On the other hand, if I was flat, I would consider shorting below 13 for the low 2. There's room to the moving average. Tight trading range, most breakouts fail. We're trying to break out of the out of the top. Okay. So this will probably fail. I would debate. I don't know if I would take that short. I might take that short. There's enough room. There are about 6 ticks down to the moving average for the short. All right, this is interesting. We have a strong bear bar. The market's still always in long. This bar closed below the lows of the past 12 bars or so, so it's a strong bear breakout. It reversed the lows of the past 12 bars. It reversed the closes of the past 12 bars. It closed below all the closes. It closed below all the lows. All the bulls who bought in here right now are holding a loss. However, it's an attempt at a bear breakout, and I think the market's still always in long. And when the market's always in long, most bear breakouts fail. So the odds are this bear breakout will fail. Aggressive bulls will buy the close of 14 and scale in lower, keeping a stop maybe below the low of the bull spike, maybe a tick or two below the high of the signal bar. So I would not short, and I would not be holding short. I would, had I shorted below 13, I would have scalped out. Had I not shorted below 13, I would buy that close, the first close below the moving average, an attempt by the bears to reverse the market. They should fail. The market's still always in long. The market went sideways a little bit and then turned up, and the bear breakout did fail. Some traders are looking for scalps all day long on the 5-minute chart or on whatever chart they use. They just take whatever scalps they see during the day. And it's easiest to see scalps when the markets are clear, and they are most clear during very strong trends and during very obvious trading ranges. They're less clear during channels. I talked about how to trade very strong trends, breakouts in other modules. I've talked about trading ranges in our module as well, but I'm going to talk specifically about scalping within a trading range over the next group of slides. All right, so this is what you see. First bar of the day. Gap up, good for the bulls. Yesterday ended with some trading range type of behavior. But look at this bar. Remember, the first bar of the day often gives you an idea about what the rest of the day will be like. Okay, we gap up, but first of all, the bar is not all that big. It's certainly not bigger than the biggest bars at the end of yesterday. And its body is small, the tail on top, tail on the bottom. And that's a trading range bar. So that can be a clue that today will be a trading range day. It's a trading range bar, so entering with stops is usually bad. It's a trading range bar, so the market will try to regress toward a mean. One mean is the moving average. So to me, there'll probably be buyers scaling in below, but not right below, probably closer to the moving average, and sellers scaling in above. So to me, it's a short. If you're looking for a scalp, it's a short above the high of the bar. How far is your stop? I probably would start with a stop maybe 3 points away and sell here, maybe add on 1 point up and add on 2 points up. All right, this is looking good for the bears at this point. 2 closed on its high, but no follow through. It was a breakout, closed above the prior bar, but it closed with the very next bar. And now we have a bear bar closing on its low. So far, trading range behavior. 4 overlapping bars. The bars are small, bars in both directions, and prominent tails. Trading range behavior, far above the moving average. We should get down to the moving average. I think it's an okay short below the low of this bar. Good bar for the bears, but so far 5-tick failure. So what do the bears do? Double bottom bull flag. Tough call. I think the market is going down lower, but 5-tick failure, a lot of scalpers will get out at break even. Alternatively, you can say, well, pretty good breakout, I'll take my chances and I'll put my stop above the high of this bear bar. And there's no right answer. I think both are okay. However, I think trading range behavior so far. This is also trading range behavior. a bear breakout bar, and instead of follow through, the next bar, a bull reversal bar. So again, trading range behavior, small range. We should get down to the moving average before very long. So I think either you get out, break even, and then look to sell again, or you hold with a stop above that bear bar. I don't know what happened first here. I don't know if it went above and then below, or below and then above. So depending on how you managed it, you may have made a profit. Okay, 3 pushes down, the tail on one, and then this bar, and then this bar. A high 2 buy, but it's not a bull trend. To me, this is a small trading range type of market, and it could be the low of the day. I think you can take that for a swing long, but I think chances are you'll lose. But if your reward is sufficiently big, you'll be okay. So for me, the bull case, I'd like to see a breakout and follow through, and then I'll chase it higher. Otherwise, I'm going to assume this trading range behavior will continue, and if it does, we should get down to the moving average. All right, a breakout bar for the bulls, but it's small, tail on top. And now we have IOI with a bear bar. Tricky call here. It's a failed high 2. IOI, we should get to the moving average at a minimum. My guess is we'll get at least 1 tick below. So I think you can scalp this, but be quick to get out if it does not go your way. Good bar for the bears, 6 ticks down, the bears get out. Now what to do? Is it a short the close bar? We have a trading range. We had a reversal down and a reversal up, so the market's in breakout mode. Traders will be buying on a stop above this swing high. They'll be selling on a stop below this swing low, looking for at least a doubling of the range. So at this point, we got the breakout below, and we got a close on the low. To me, I think we're going at least a little bit lower, so I think you can scalp that with a stop above, and make sure, and then get out depending on what your actual risk turns out to be. Okay, so if you sold the close of that bar, you probably scalped out here. Is it still a trading range day? We have a breakout, and we have bear follow through, but we have a tail, and the bar after that is a doji, and now we have a bar with a tail. So to me, this is still possibly a trading range day. 3 pushes down, here, here, and then here. Trapped bears below here if we turn up. Is this an opening reversal buy? It might be, but with 5 consecutive bars down, I'd rather buy above the bull bar. Micro wedge, 3 pushes down here. You could buy above there. If you're really aggressive, once you start seeing these tails, you could place limit orders to buy the lows of the bar and risk maybe 2 or 3 points, looking for a scalp up. As far as buying above the micro wedge here, I would not, but I do think it's certainly a swing buy above this bull bar, a 2-bar reversal with either this bar or with that bar. And you know, to me, I could see buying that and putting a stop below, looking for at least a little bit more up. There's 5 ticks to that low, and maybe we'll go a tick above. I think that's an okay buy. Okay, at this point we have 4 bars up. We might be flipping to always in long, but look at the bars. You know, 1 tick bull bodies, not really impressive. I think we're probably going to go higher. This looks like a bull flag, a bear channel, bull flag, and we have a bull bar for the buy. At the moment, I think this is not all that strong. I think we're always in long. I think there are buyers below. I think it's okay to place a limit order to buy the low of that bar with a stop maybe below the low of this bar, maybe even scaling in 1 point down. As far as buying above the high of this I think we're going higher. I think we went always in long on this reversal up, but to me it's not a strong buy. It's a pretty aggressive buy. Okay, a better looking bar, this bull bar, so possibly buying above its high, but for the bears, they still could be in a bear channel. We could be forming lower lows, lower highs in a very broad channel. We have a failed breakout above this bar, tails, micro double top, and then we have a triple top. We should test down. This is not that strong a channel. I think we're always in long. It's maybe an 8 or 9 bar micro channel, no pullbacks. I think the bears have a case that it is still in a bear channel, and it is. We're forming lower lows and lower highs, so it's still a bear trend. but it's also a bull trend, and it's possibly, it's also a trading range, and it's possibly a bull trend. We need clarity. To me, this looks like a trading range day. This leg up, yes, it's a bull leg. Yes, we're always in long, but it's not a strong bull leg. So it's probably a bull leg in a trading range. So I think you can short that for a scalp. We should get down to this low at a minimum. 5 ticks down, maybe we'll go a tick or so. High 2 buy here, I would not take it. 4 sideways bars, not a strong bull leg. I think we'll probably come somewhere down in here. I also would not take that long, a wedge bull flag. To me, this leg up is not all that strong, so I think we'll get a deeper pullback than just a few ticks. Bear breakout, right? So this is interesting. The bulls see this as a breakout pullback from this rally. So a small higher low major trend reversal. We had a bear trend. We have a breakout. We have a higher low. And the bears want follow through. If it's a trading range day, breakouts fail, so there probably will be buyers above this bar. We fell below this ledge, and instead of getting follow through, we have a doji bar, hesitation. You have the wedge bull flag possibility. I think we're still always in long. I think it's an aggressive buy above the high of this bar. Maybe put a stop below the low of the bull spike. It's still always in long as long as it's holding above the low of the bull spike. Strong reversal bar and confirmation of the higher low major trend reversal. We should go higher. I think you can buy that close with a stop below its low. Micro double top, but I think this is simply going to be a pullback from this breakout. Could you buy this double bottom, high 2? I think you could. Now, is the day a bull trend day, a bear trend day, or a trading range day? This move above the lower high, I think, eliminated the bear trend argument. So right now it's either a bull trend, and it is. We have a higher high, we have higher lows, we're always in long, so it is a bull trend, but it's also a trading range, and we're near the top of the trading range. And as a bull trend, it's not in the strong breakout phase, it's in the channel phase, and with this deep pullback, the channel is pretty broad. Okay, so if it's a trading range, we're above a high, you look to short. With these 3 bars up, especially with this big bull body, I would rather wait for a second entry short. Can you short this 2-bar reversal? You can, but I think your stop is above that high. To me, this is up too sharply from this low. I would wait for a second entry short. Okay, we have an I, 3 consecutive inside bars. For the bulls, it's a breakout pullback buy. We have a breakout and a pullback. If you think it's a bull trend day, you could take this buy for a swing. I don't think the probability is high enough for a scalp. And if you think it's a trading range, it's a short above here because we're trying to break out near the high of the day. To me, I would probably wait and get more information. We have a triangle, 3 pushes up, 1, 2, 3, and we have a bear breakout of the triangle. You could argue taking that short. As far as the failed breakout goes here, right now we're in the middle of the trading range. And look what's happening so far today. I think something important. The market fell below this low, found buyers. Fell below this low, first reversal up, it was profitable. It fell below this ledge, it reversed up. It went above this bear bar, which would have been the stop for some of the bears, and went down, right? So this is trading range behavior. It went above this bar and found sellers, right? Tried to break out here, reversed down. Went below this low and below this low and below this low, found buyers, right? To me, this is trading range type behavior. People are buying below lows and they're selling above highs. With that in mind, what about buying below this low? I think the doji bar is not, at this point, I would not take the long. This doji bar is not enough to reverse that bear bar and this bear bar. However, I think we're probably in a trading range day, and I'm looking to buy low, sell high, and scalp. When in doubt, I'll wait for second entries. Possible double bottom, bull flag. But trading range days usually falls below support. This is support. So I'd like to see if we fall below support and then look to buy. Okay, outside down, 2-bar reversal. Second entry buy. I think you can buy this, or you can say, the channel down is pretty tight. Maybe I'll wait. I don't have a right answer. I do think it's an acceptable buy. I'm concerned about the tightness of the channel, and I think it's also okay to wait. Another way to handle it is you take the buy and just use a wide stop, maybe like a 3-point stop, and scale in below. So you buy this, 1 tick above, and then you add on, a tick or so below here, and maybe use a 3-point stop. I don't know. To me, this is. I don't know. My inclination is I would wait and get more information. All right, micro double top. I would not take the short. I think there's too much risk of reversing up from a third push down. So I would not take that buy. I would not take this short, but I'm looking to buy. And we have a bear spike, and now we have 3 pushes. We're near the low of the day. If we get below the low of the day and get any kind of reversal, I'm going to look to buy. This looks like a trading range day. Every time we go above something, we're turning down, and when we go below things, we're turning up. And we're trying to break out, and most breakouts fail. Okay, inside bar. So possible final flag, the bottom of the trading range. And now I have a 2-bar reversal closing on its high, and a wedge bottom, and a reversal up from the low of the day, and a 1-bar final flag. To me, I think that's a good 5 bars up, probably always in long. And as far as this is a short, I think we're going to get more up. We have a wedge bottom. We should get 2 legs up. So I'd rather be looking to buy than to sell. There should be buyers below here. Where's their stop? Probably below the signal bar low, maybe below the entry bar low. And we had a breakout pullback, 2-bar reversal, strong bull spike, and that was the end of the day. This is the next day. Some traders prefer to scalp on smaller time frame charts, like 1, 2, or 3-minute charts. Others use charts based on volume or on ticks. They're trying to get more bars in the day. For example, on the 5-minute E-mini chart, there are 81 bars in the day, and you can create charts based on ticks or volume to get 200 bars in the day, 300 bars in the day. And other traders prefer to use other types of charts like range charts. Here's an example of a 1-minute chart, and if you look over here on the right, when the bars start to become small, 1, 2 tick tall, 3 tick tall, lots of dojis and small bodies, usually there's not enough information on each bar to place trades. And if you're trading a 1-minute chart and the chart starts to look like this, a lot of times traders will go up to the next higher time frame, like a 2 or 3-minute chart. However, in the first hour or so, the 1-minute chart looks like this, and it's virtually identical to a 5-minute chart, and traders will look for scalps. So for example, we have a big gap down, but not big bars. So this is trading range type behavior. A big gap down, trading range behavior, the market should regress toward the mean. 2-bar reversal, micro double bottom, failed bear breakout, traders will look to buy. They'll buy above here. A bull signal bar, a bull entry bar and a bull signal bar, a pullback, a breakout, they'll buy above here. Now we're starting to get a strong move up to the moving average. This is the 1-minute moving average. I don't have the 5-minute moving average drawn on this chart. But once the traders start to see, 3 or 4 consecutive bull bars, they'll look to buy. They might buy here, hoping to get to the moving average. If they did, they probably would use a stop below the bottom of the spike, either below here or below here. If they saw that doji close, they probably would exit and look to buy lower. As long as the market is staying above the bottom of this bull spike, they'll assume the market's always in long on the 1-minute chart. So they'll look to buy pullbacks. They probably would not buy here, so close to the moving average. But by this point, there are 3 pushes down. 1, 2, 3. A bull close, not ideal, 1 tick body. They might take that buy. They certainly would not take this sell because the market is still always in long, and there may not be enough room down here for a scalp. Also, the bulls see this breakout and they see the failure. The breakout has 2 ticks, the failure has 1. It's more likely that this will result in a pullback from the breakout rather than a reversal. When they see this bar for the entry bar for the bears, the bulls will feel good. They'll either buy the market or 1 tick above its high for a scalp. If they bought above its high, they need the market to go up 6 ticks to make 1 point. It went up 5 ticks, so they have a 5-tick failure, new high of the day, 2-bar reversal. They probably would get out around break even. The trend up is not all that strong, so for me, when I start to see small bars like this, dojis, big tails, I'm assuming trading range behavior. I'm no longer interested in buying near the high. We're starting to get too many dojis in here, too many small bars. I would stop trading the 1-minute chart. Here's the 2-minute chart of the same day. First bar of the day, close in the middle, big tail on the bottom, small bar, second bar of the day, small bar, 1-tick body, trading range type behavior, big gap down. The market should regress toward the mean. Okay, trading ranges, you buy low, sell high, you scalp. We have a big gap down, we're low, so it should go up. So traders would buy above the high of this bar. 3 bars up, 4 bars up, market's always in long. They're looking to buy pullbacks. They may place a limit order to buy at the low of this bar and then try to add in 1 point lower. It would have hit their add on limit order here, but not filled them. And with the market reversing up like this, they would feel good. They would feel like there was a lot of buying pressure. A lot of people were trying to buy 1 tick down. That means the market's probably going higher. Again, they're always in long as long as the market stays above the bottom of the spike. Okay, so they might buy above the high of this bar as an outside up bar and a failure for the bears, and their inability to scale in lower, and they would put their stop below the low of the bar trying to scalp out. The market went up 6 ticks, enough for them to make their profit. It hit the 2-minute 20-bar exponential moving average, and they would trade it just like any other chart. So they see two legs up, a strong spike, channel type behavior going up here. So a spike in channel, hit the moving average, and a 2-bar reversal, a reasonable short. Market comes down, and we have a big tail on the breakout below the prior low, the bottom of the channel. The market usually tries to bounce at the bottom of the channel. So the the bulls would wonder if this is a double bottom. To me, that's not a very strong buy signal bar. Here is a second entry long. I could see buying 1 tick above its high, putting a stop below its low, and the market tested the low, micro double bottom, and turned up. So if you did not buy here, you could buy here. Basically a triangle, 3 pushes down, and a double bottom with the earlier low, and always in long with this bull spike. Now we have another bull spike. Strong breakout. The bears are trying to create a failed breakout, but the failure is smaller than the breakout. So traders could treat that as a breakout pullback and buy above its high. Another triangle. They might buy above it. It's holding above the moving average. But now we're starting to get these small bars, doji bars, and the bodies. So we're getting less information from each bar. I think if I were trading this, I would move on to another type of chart. You could hold up here, and the bulls tried to get a breakout from 2 bear bars, and they failed. They have a 2-bar reversal, and they're above a trend channel line. That probably would be a reasonable short. 3 pushes down, wedge, went sideways instead of up, and then 2 pushes up, bear bar closing on its low. Had I bought this, I would have exited, and I would consider going short. And that's the end of the module on extreme scalping. And again, as I said, I think most traders should not do it, or if they do it, they should not do it in as extreme a fashion as I showed on this chart. You can make money doing it, but if you do, I would look, let me rephrase that. You can make money scalping for 1 point, but if you do, you have to trade big volume and you have to be very selective. I would not try to take 40 trades a day unless you were young enough to be able to keep it up all day long, and unless you were extremely good at chart reading. And if you're that good at chart reading, you probably would be happier and more profitable if you went for fewer and bigger trades, more swings.